Welcome back to my channel, Balance Sheets Matter. In this video, we're going to be looking at McCormick and Company, also known as MKC stock, and do a stock analysis on it. But before we get into that, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos, so if you want to get good ideas and potential value stocks to buy or value traps to avoid, make sure to subscribe to the channel. And how we do this is I look at basically the financials, see what the current state of the company is, see what things are improving, see what things are getting worse, and from all that information, try to figure out what a reasonable value for the stock could be and where it is potentially headed going forward from what we're seeing in the financial statements. So now to get into the stock analysis with McCormick here. Now this is a video stock I'd actually done a video on a couple years ago. If we go back here, well, not this far back, but you can see we did it 2 years ago, and I was talking about where a potential value may be for the stock, which if we go to my chart here, I was saying, I would probably be interested around $53 when I originally did the video back here. So we're maybe going to review a little bit of what I said in the past video and give a new update of kind of, is that still accurate? Is it potentially looking like a good buy now, and how the financial status has changed for McCormick? So first thing is, right now, it's like a lot of people do see this PE of 8.91 and they think, wow, that's a really good deal. But as I'll explain in the financial statements, this is artificially not really the case, because we can see the forward PE is 17.54, which is based on the analyst estimates going forward. Also, for the dividend investors, there is a 3.37% dividend with a payout ratio of 0.6. So let's get into the 30-year financials here. So you can see here basically the revenue trend, and we can see it has been 4.6% per year over the last 10 years, which is a little low. But the EPS without NRI is 6.4, which is a little bit better. So just look at the financials here. You can see right now the company, like as we showed on the chart, has been dropping a lot, and we can see that the return on invested capital has not been strong basically since 2020 when the stock peaked and started going down. So before, they had a lot better return on invested capital when they take money and reinvest in their business, and now it's dropped down to about 6.2%, which is actually marginally lower than their weighted average cost of capital, which is now 7.8, which is either the cost of them taking debt or issuing new shares. And you can see in all these previous years, that's not very good. So this is one of the reasons the stock has been under a little pressure, and I'll explain why that is in the rest of the financial statements. So we can see, actually, if we look back, for example, 2011, a little bit more than 10 years, the stock actually has had some, good overall growth. They have been continuing. They do some acquisitions. And the first thing I like to look at is the gross margins, because the one thing I pointed out in 2022, there was a very large dip basically in the gross margin. And you can see right when that started happening, there is a very big crash in the stock. So, margins do matter. And luckily, they have been able to recover that a little bit. But this isn't quite back up to the historic trend. They've got it from, about just under 36 back to about, 38%. And a lot of this can be due to if you have long-term deteriorating gross margins because you're losing your competitive moat. I didn't think this was the case of the margin. I thought it was, or of the case of McCormick there, that they were losing their competitive moat. It was more just the economic scenario and a little bit of an inventory issue. You can see their inventory revenue, which I brought up in my last video, was the highest that it had been. So sometimes when you have the excess inventory, which basically happened to a lot of people who stocked up too much past COVID, you have to lower prices to clear that. And it still is a little bit on the higher side, but they have got it a little bit more under control to 0.18. And we can see after they did that, their margins have crept up a little bit, but they're not back to the previous levels they were. So this is one thing we're going to watch out, want to look at, because you will see basically as we do go into the analysis of why the stock was so much more expensive back in these days. It was a combination of basically their growing margins, which is largely the operating margin. You can see back in 2020, it had peaked at 18.19, and this had grown from the previous years back from about 2011 to 2016 being in the 14% range. They got it up to 18, and the analysts in the market, they really like to see the operating margins grow, because that means more money on the bottom line. Not only are you growing your underlying company, you're making more money on top, and that kind of really can show an acceleration phase. But then they had a contraction, and that's basically when the stock crashed. And right now, there is a little bit of a rebound happening. It is up to 15.75, which is better than the previous years from 2016, but it's still off the peak of 2020 there. And considering it's already basically up to 15.75, better than 2016 and before, when they were operating at around 41% gross margins, that does show they actually have been operating the company very efficiently, mainly meaning their selling and general admin and other operating expenses are increasing at a slower rate than the revenue. So that is actually one really good sign for McCormick, which at least could provide at least a solid, stable valuation going in the future and kind of helps counteract the potential hit to the gross margins. And if we do see a little bit tick up in the gross margins in the future, it could mean these operating margins tick up again and potentially garner us a little bit higher valuation. One negative, which I did bring up before, which has improved slightly, is the interest expense. And usually I always talk about in my videos is that I like to look for around a 1 to 10 interest expense, meaning they have 10 times more operating income than interest. This is just a much more comfortable level to deal with, because once you start having less than that, you just don't have as much flexibility. If you have a bad year, then you kind of really start getting crunched, or you don't have the money to do acquisitions and buybacks. And they are sitting a little bit under $200 million right now, their interest expense, although their net interest expense is only 155. So, that's not, quite as bad, but their operating income is 1.19. So this is a little bit weaker than it could be. It would be nice to see them pay down a little bit debt but from the previous years, they actually have improved that a little bit. So, that is good to see. And next thing is the reason why we are seeing the artificially high PE is they do have this other net income here of 941 million, which is looking like their net income is really high, but this was a non-basically cash realized profit there. So that is not really what you should expect their their earnings going forward, and is not a real reflection of what their PE is. So in the past, let's ignore this 1 year because it's not really 23%. It's about 11%. And compared to all these past years, when they were having their peak margins before, they're around like say 13%. So McCormick could be creeping up back to that. So despite this little headwind they've had here, they do seem to be on the recovery for it, which is basically nice to see. But you have to realize they aren't on an acceleration growth anymore. And before any new acceleration growth would be realized of their margins, basically, and the market wanting to reprice that in, it probably would be a few years in the future to basically start establishing this trend. We would want to see the gross margin basically get up to 40, 41%. And then from there, if it were operating margin then were to get more efficient, then that's when we would basically be seeing that reacceleration. But right now, we're still basically in recovery mode to what the previous margins were, and we're not going to be considered to have accelerating, margins and expansion from there. So we do look at the shares outstanding, and the one thing with McCormick is they really don't buy back a lot of shares. If anything, it's flat, or like over a little bit longer term, it's marginally increased. So we're going to look at their cash flow statement to see where the cash flow is going. When we look at their current assets, I did bring up before that when we did the video back in around this 2022 level time, they did have a little bit high inventories, and you can see they have grown the revenue, and they have brought those total inventories down a little bit. So they're still maybe a little high. Maybe they'll keep them at these levels, but at least it is 10% lower than before. So that is something that has been changed a little bit. We see their total assets basically sitting at about $16.3 billion, but always take note of the goodwill. And the reason why the goodwill is ticked up is they did do an acquisition. So, it is basically $6.3 billion of goodwill, because we look at, their total equity, $7.5 billion. Well, that's not real total equity. I always like to take with the goodwill. So we're sitting at a little bit over $1 billion, which is positive equity on the balance sheet, which is good. And then we look at their liabilities. You can see the one thing they had before is they actually did take some short-term debt out in 2020 and 2021. This was due to acquisitions, but because short-term debt typically is a variable interest rate based on, SOFR, the Fed's funds rate, when interest rates increase, that kind of caused their interest expense to increase as well. But you can see this basically has been paid down over time, but it has increased back up a little bit because they did another acquisition. And then you can see the long-term debt, it's, stayed relatively steady over this time. It again picked up a little bit as well because, presumably because of this acquisition. So anyways, like with their previous debt ratio they had before, it obviously indicates they do seem, quite comfortable with the interest expense they have, but we probably won't be seeing any new acquisitions in the very short-term future, And I would probably want to see them starting to pay down a little bit of debt, because if we go on to the cash flow statement now, let's just skip right down to that basically. And you can see after the previous years when they did do their acquisitions here and they had some net issuance of debt, they did actually for 4 years they diligently paid that down, actually, and a little bit more, a little bit over $1 billion of debt paid down. And now, in the last 12 months here, they're at a little bit of increase of net issuance of debt of close to $600 million from the acquisition. Where you can see the acquisition as we look at the purchase of businesses here. So you can see this happened in the last quarter here. So we probably would expect to see some growth going forward because of that. And you can see in the past, 2020 and 2021, they had some small acquisitions there, a really big one in 2017 I talked about in the past video. One other thing I had brought up before is when we look at the cash flow from depreciation and we compare it to the purchase of plant, property, and equipment, because there's two things that you can take from this. Is one, that if they are spending more, this can be because they are expanding the business. Slower companies like McCormick, that usually isn't so much of the case, and it might just be because they're not actually depreciating the assets on their balance sheet as fast as they should. So that can take a little effect into the equity we're seeing on the balance sheet. But anyways, they are expanding a little bit as well. As you see, they do actually have some revenue growth going forward. But you can see actually now in the current years, it seems that doesn't seem to be the case, because now in the last basically 12 months, it's been $217 million in purchase of plant, property, and equipment. But the cash flow from depreciation was $241 million. So it seems like they're now much more at replacement value, which kind of means what we're seeing on the income statement in the future, if this continues, should be relatively reflective of actually what their free cash flow basically is. So that's a good sign. So overall, I think McCormick, from what we've looked at so far, is looking pretty good to some degrees of other than the little bit higher interest than we need this margin recovery. And if the margins got worse, that would obviously smack down the stock a little bit more. And then the other thing we can see is the repurchase of stock, very, very minimal. And this is largely because remember in 2017, we just saw this acquisition right here. Basically, they've been focusing more on acquisitions and they don't have the excess money to basically buy back the stock. What they do is, they do pay their dividend, which I think was 3.3% or so. So they spend a good chunk of money to do that. And then basically with the rest of their key cash flow, if you look at a non-acquisition year, they're usually paying back some debt. So, what is basically McCormick doing? McCormick is taking all the money they have. They're going to, pay out, whatever they're basically paying out in the dividend. And they're going to use the rest of that either in some years, they're going to basically pay back some debt, and then they're going to do an acquisition to basically kind of fuel the growth. So overall, the company is pretty stable. They have got basically, smacked down just because of that little contraction in the margins, the gross margin there, but the operating margins are actually, very, very strong and actually improving, I would say. But that is one thing we do want to watch, because that is going to actually have some guidance for the stock going forward. So now we're going to look at the interactive chart here and bring up the revenue with estimate and the EPS estimate without NRI. One thing is, I think this revenue estimate is a little bit off. Doesn't really make sense why they would jump hundreds of percent. So let's just get rid of that. But you can see right now, the analysts are expecting EPS to grow at basically 10% a year going forward. So, if that is true, that is actually a very good growth rate for, EPS there. So that, would be, quite positive. The next thing we do is we're going to look at the price to sales ratio, because when we combine this and the net margins, this is going to basically tell us something about the stock. And you can see basically how the price to sales ratio got really, really high up here and has now come crashing down. But does this mean it's a really good deal? No, not necessarily. So I want you to kind of take some periods here, and I want you to look at for about, say, this 2010 period here, where we had a low of about 1.5, this 2016 period, where we had a high of about 2.5. And right now, consider we're at 2. And then after 2016, we had a low of about this 2.6 here, 2.5, and we had a high of 5. So now let's take away the price to sales ratio just for scaling purposes, and I'm going to bring up the margins here. So let's bring up the net margin here, and I think we can bring up the operating margin too to get into what I'm saying. So you can kind of see here during this 2010 to 2016 period, we had stable net margins around 10 to 11%, and operating margins were relatively stable too in this, 14% range. And then where did they get the big markup in their price to sales ratio from going to 1.5 to 2.6, from 2.6 to 4.6, I believe it was? Well, you can see what I'm talking about is this acceleration of the operating margin and the net margin basically at the same time. Because when the market basically sees this, the analysts, the institutional investors, they think, oh, wow, not only is this stock growing at whatever rate they are, but, you're kind of getting double growth because, well, growing as in the revenue, you're going to be getting double growth on the bottom line because their margins are expanding, and this company is actually in an expansion phase. And that's why something, for example, like Costco, which I've talked about recently, has fetched such a high P ratio, now pushing 50, because they are constantly expanding their net margins right now. The thing is this doesn't always last forever, and now it's come back and contracted. So you have to consider right now that the operating margin still actually is a little bit better than before in this period. But if it were to tick down a little bit even, it would still be very comparable. So I think when we are looking at valuation, looking at 2010 to 2016 is a relatively conservative estimate to look at. We can also look at the net margin here. Same thing speaking, a little bit higher than that period on the upper end. So when we bring that back, we already know what the price of sales was. Before, the range was basically 1.5, 2.6. Now we're at 2, which is basically kind of smack dab in the middle of it. Now let's look at the PE ratio. So if we look at the PE, we can see that basically during this 2010, there was effectively lows, of just under a 15. So kind of on our low range, it was a 15 P ratio, and getting up into 2016, you could get into maybe the high 20s. But then when they did have this acceleration, it looked like they were actually an expanding business. They were actually pushing typically a 30 P ratio and higher, even up into the high 30s. So what's basically happened is the market realizes that that type of expansion basically is not happening anymore, and it's being re-rated down to more reasonable price to earnings ratio, which I think right now the market's probably going to be looking at it probably in this range of the 15 to say 27 as a fair PE ratio. But you have to remember that if there would be a potentially reacceleration, as I said before, it probably would take a couple years for that to occur. So that is a potential tailwind, an upside surprise that basically could happen to the stock there. So now let's jump into the chart here and get into my analysis. And you can see I have this very large technical analysis and a little bit of price forecasting. You can see I have this very long-term trend here, and this trend, I like to put up these now. It just kind of shows what 1 year is, and it's a little bit under 10%, which is fairly in line with the EPS growth. And you would kind of expect stocks to actually, trend in the long term with their EPS growth. So if the analysts are right, this will actually be, quite accurate, and that does seem like that, is a possibility from at least their, strong efficiencies with their operating margin that are happening. And before I was talking about the stock at effectively, I put a price target of I would start getting interested at $53. And we can see we've kind of like hit right into that point, a little bit lower, and I have two new lines drawn basically at around a 50 and a 45, because looking at their forward estimates, I believe it was 3.36 in 2028. So that's, a double kind of forward PE. Right now, we already know at this current price, the forward PE was 17.5. So you have to consider the low end, kind of like rock bottom pricing for McCormick there is typically around that 15 PE ratio. So that is a little bit lower than what it is today, and about 14% lower. So what does that bring our price to? Just doing a little bit of math on calculator, that does bring us more into the $45 range, and it could get a little bit lower. So will it actually get there? It's hard to say, but usually when you get these big knife balls like this, the stock isn't going to recover right away. You can get something like this where it's already popped up, and you're going to grind sideways for a while. Or typically during your more sustainable bottoms, you look here, it hits a bottom, rebounds up, comes back, does a retest. This is, November 2008, and it rebottomed, in May 2009. So it's actually very, very long bottoming periods. Usually have 6 months plus before these longer term bottoms actually occur. So I'm not really in any rush to buy McCormick now. I do think it could be potentially a very good value. I would want to be watching it, and I do think that probably looking at like $50 if it's getting 50 to 45. That's where I personally would be maybe looking at kind of getting a starter position, but also realizing that with stocks like this, it could basically bounce around a while before it actually takes off. And then you also have to, calculate in what your upside is. If our upside is, talking in a couple years, $3.50, even at a more optimistic PE of 25, that is only putting us at a potential, $87 price point. So, if we put $87, that's here, that's, 2028, somewhere there in the future. And that's like, is that really worth the upside for you for that? Because 25 would be at the, higher end of the range. So this is one that I feel is probably, in my opinion, what I'm going to be doing is looking for if it drops back again to accumulate it, or if let's let it burn off some time. And if it does get lower and any really aggressive falls, I would probably definitely be looking at 45, since you can see we've got this price volume profile here, which is acting as support. But a lot of times these lower ranges from the previous consolidations, these stocks will reach that, especially after such an aggressive fall. So anyways, I think McCormick is, like I said, is in a relatively good position. There is a little bit of pressures on it, as we've seen and I've explained already, but because of their efficient operating margin and the fact that actually the trend still does look like it's on a good upside, there could be some positive, potentially surprise in the future. And I think basically buying at these lower levels does provide a good, protection of the stock, that if you buy it here, you could wait for a while, and if things actually did really deteriorate, you'd be able to get out of the stock without getting hurt too much and losing 50% on it, like which happens with a lot of other stocks there. So anyways, that's my opinion on McCormick and my stock analysis on it. So make sure to subscribe to the channel, like the video, and I will see you in the next stock analysis video.